This is Bob, the world's worst market timer. This is the story of Bob's terrible market timing purchases in the stock market. Bob began his career in 1977 at the tender age of 23. He was always a diligent saver and planner, so his friends weren't surprised when Bob mapped out his entire retirement savings plan in advance. Bob would save $2,000 a year at the outset of his career and bump up that amount $2,000 every 10 years until he could retire at age 65 by the end of 2019. Simple enough, right? While Bob was a diligent saver, his investment skills left a lot to be desired. He kept all of his money in a checking account, earning 0% interest on his savings until he was ready to put that money in the stock market. Bob's problem as an investor was that he only had the courage to put his money to work in the market after a bull market was underway. So after witnessing a 60% run-up in prices from 1977 when he started through Thanksgiving of 1980, Bob was finally ready to put his first $8,000 of savings to work in the newly formed Vanguard S&P 500 index fund. And then, well, the market proceeded to drop nearly 30% over the next 18 months or so. Not great timing on Bob's first purchase. Although he invested right at the peak of the market, Bob did have one saving grace. Once his money was in the market, he never touched it. Not once. He held on for dear life, never selling his fund shares because he was far too nervous about being wrong in a sell decision, just like his bad buy decision. I want you to remember this decision because it's a big one in our story. Now, where were we? Yes. After his initial foray into stocks came just before a bear market, Bob didn't really feel comfortable about putting his savings back to work again until the fall of 1987, after another huge bull market had taken hold in the mid-1980s. Bob's greed was now increasing, so after 7 additional years of saving, Bob now had $16,000 sitting in his checking account ready to go. Again, he invested in the S&P 500 index fund, and again, he top-ticked the market just before another brutal crash. This time, stocks lost more than 30% in less than a week in October of 1987, a week which included the largest daily drop in the history of the stock market on Black Monday. Timing obviously wasn't on Bob's side, so he continued to keep his money invested just as he did before, while stashing any new savings in the bank. After the 1987 crash, Bob was feeling pretty bruised and battered, not really feeling comfortable about putting any new savings to work back in stocks until the tech bubble really ramped up by the end of the 1990s. He now had an additional $54,000 of savings to put to work in the market, and this time his purchase right at the end of the 1990s came just before a massive 50% plus crash in the bear market of 2000 to 2002. This was now the third time Bob invested stocks right at a market peak, which left him with some more scars, but he decided to make one more big purchase with his savings before he retired. That final investment, unfortunately, came in October 2007, when he invested $50,000, which he had been saving since his last purchase around the turn of the century. Bob rounded out his string of horrific market timing purchases by buying right before another bone-crushing 56% crash during the 2008 financial crisis. Whew, poor Bob. After the great financial crisis, Bob decided to continue stashing any future savings in the bank, but kept his stock investments in the market until he retired at the end of 2019. Let's recap. Bob was obviously a terrible market timer. His only 4 stock market purchases he ever made in his career came right before a huge market peak, just before extreme losses. He nailed the market peak every time, and not in a good way. Luckily, while Bob could never time his buys right, he never sold out of the market. Not once. He didn't sell after the bear market of 1980 to 1982, or the Black Monday crash in 1987, or the technology bust in 2000, or the financial crisis of 2008. In fact, Bob never sold a single share. So how do you think Bob ended up? Better than expected, actually, considering he only invested at market peaks. Even though he only bought at the very top of the market, Bob became a millionaire with $1.1 million when he retired in 2019. How could that possibly be, you might ask? First of all, Bob was a diligent saver and planner. He never wavered on his savings goals, and he increased the amount he saved over time. Second, he allowed his investments to compound through the decades, never selling out of the market once over his 40-plus years of investing. He gave himself a long runway and allowed patience to make up for any ill-timed purchases. And they were ill-timed. He did have to endure a huge psychological toll from seeing large losses and sticking with long-term mindset, but I like to think Bob didn't pay much attention to his portfolio statements over the years. He just continued to stay invested and kept his head down. Of course, maybe it's a stretch to believe Bob would have had enough intestinal fortitude to hold his stocks after making such terrible purchases, but the point is, with a long enough time horizon, even bad decisions can get smoothed out by compound interest. And can you imagine if Bob had simply dollar cost averaged his money into the market over the same time frame instead of constantly making bad market timing decisions? Had Bob periodically invested over this time instead of trying to time the market, he would have ended up with nearly $2.5 million instead of $1.1 million. But then he wouldn't be considered Bob, the world's worst market timer.